Welcome back to this channel for practice problems for actuarial exams. My name is Krzysztof Ostaszewski. You can find information about me at smarturl.it/Jedi. I direct the actuarial program at Illinois State University, which is a center of actuarial excellence, designation earned from the Society of Actuaries, and also won the 2016 Casualty Actuarial Society University Award. You can find information about our program at smarturl.it/actuary. If you would like to make a tax-deductible donation to our program to help support our actuarial students, please go to smarturl.it/help ISU actuary. This is a Society of Actuaries problem number 22 from the sample of written answer problems published by the Society of Actuaries. It's about pension funding. Let's look at this story here. On December 31, 2015, Nancy, who is age 55, has 25 years of service. Her salary in 2015 was $50,000. The annual accrued benefit as of any date is 1.6% of the 3-year final average salary as of that date, multiplied by years of service as of that date. The pension is payable only to retired participants as a monthly single life annuity, with the first payment due at retirement. The valuation assumptions are as follows. There are no benefits except for retirement benefits. Exits from employment follow the illustrative service table, except that all lives surviving in employment to age 61 retire at that time. Retirements at age 60 occur at the exact age 60, while other decrements at age 60 occur throughout the year after the retirement at exact age 60 and prior to exact age 61. After retirement, mortality follows the illustrative life table. Annuities are valued using the two-term Woolhouse formula. Nancy has received a 3% salary increase on January 1st of each year for the last 5 years. Future salaries are expected to increase by 3% each year on January 1st. All contributions are paid on January 1st each year. The interest rate used for valuation is 6%. So that's the end of the data. Now we'll look at the questions. Part A. A pension plan may be classified as a defined contribution plan or as a defined benefit plan. State which type of plan Nancy has and briefly describe the other type of plan. Part B. The actuarial accrued liability for Nancy at December 31, 2015 using the projected unit credit funding method is $150,000 to the nearest 1,000. Calculate the actuarial accrued liability to the nearest 1. Calculate the normal cost for 2016 using projected unit credit. Part C. The actuarial accrued liability for Nancy at December 31, 2015 using the traditional unit credit funding method is $126,000 to the nearest 1,000. Calculate the actuarial accrued liability to the nearest 1. Calculate the normal cost for 2016 using traditional unit credit. For Nancy, Part D. For Nancy, the normal cost during 2016 using projected unit credit is less than the normal cost during 2016 using traditional unit credit. Explain why this will be true for all employees near retirement. So Nancy has a defined benefit plan. A defined contribution pension plan specifies how much an employer will contribute as a percentage of salary into the plan's trust account, which is then contributed into an individual account of a plan participant. The employee may also contribute, that's typical in the U.S. The contributions are accumulated in an investment account which is available to the employee if he or she leaves the company. The contributions may be set to meet a target benefit level, but the actual retirement income may be well below or above the target, depending on the investment performance of the investment account of the employee. Now for Part B and C here, we need to remember that Nancy will retire at age 60 or 61. In 61 it's definite, but it is possible also at 60. So we will need to know the accrued benefit at both 60 and 61. We'll also need to know the monthly annuity values at age 60 and 61. And we use the two-term Woolhouse approximation, and we obtain that A double dot per 1260 is A double dot 60 minus 11 over 24, and that using the data from the illustrative service table, that will give us 10.6871. The annuity is actually given in the illustrative life table. Now for 61, it's 10.4458. Now under the projected unit credit cost method, the actuarial accrued liability is the actuarial present value of the accrued benefit. The accrued benefit is equal to the annual projected benefit at the decrement date multiplied by the number of years of service as of valuation date, and by the accrual rate. So we have the following information. So the projected final average salary at 60 is the current salary of 50,000 projected at 3% over 3 years and then averaged, and it comes out to be 56,292. Projected final average salary at 61, the same projection but 1 year later, comes out to be about 57,981. At valuation date, we have 25 years of service. Accrual rate is 1.6%. Projected benefit for retirement at age 60 is at 56,292 times 0.016 times 25, so it's 22,517. Projected benefit for retirement at age 61 is a higher salary, otherwise the same calculation is 23,192. And the actual accrued liability is the actual present value as of the valuation date of the projected benefit, and it's given by the formula we'll see in just a moment. So here is that formula. We project the benefit, and then we calculate it for age 60 retirement, age 61, based on the probabilities of those retirements, which we get from the data in the table. And so plugging in the numbers in the table, we get 150,072. Next part, we calculate accrued benefit at age 56. Now there's 26 years of service, so the projected benefits go up because of multiplication by 26, and the actual accrued liability as of December 31, 2016 is given. Well, it's the same calculation, but now the person's 56, so it's all adjusted for that. And then we look up the data in the table. We have the annuities from the approximation that we established before, plug it all in, and we get 169,282. Now, to establish the normal cost and normal contribution, so as you termed in that book that is now the main reading for the exam MLC, we use this recursive formula that is at the core of the normal cost calculation in that book, which says that the previous year reserve or accrued liability plus normal cost is the expected present value of benefits for mid-year exits, assuming that exits happen in mid-year, plus the present value for those surviving of the accrued liability a year later. And we note that the expected present value of benefits for mid-year exits is 0. So then the middle term in this formula is 0, and we plug in all the other terms, and from this we obtain the normal cost to be 6,003. Then we switch to part C for traditional unit credit method. Now the actual accrued liability is the present value of the accrued benefit on the valuation date, but we don't project the salary. We just take the average taking into account the current salary, 50,000, so the last 3 years, and 25 years of service, so this is what we get for the benefit at age 55. And the accrued liability is calculated based on that benefit, discounting the value of the benefit annuities for possibilities of retirement at age 60 and 61. And so then we plug in all the numbers and we get 126,277. Now, because we don't project the salary, you can see that this causes the accrued liability to be smaller. Then we go to age 56. We do the same type of calculation as before, but now the salary was 50,000. Now it has increased by 3%, and we still use the last 3 years as of now of the salaries for the calculation. We get 10,806. Now, using that and the annuity value of the annuities at this level of benefit, and then taking the actuarial present values based on that, we plug in all these numbers from the table, and we obtain 146,698. And the same normal cost calculation with mid-year exits having 0 value. So after we plug in all the numbers, we can calculate the normal cost to be 8891. So what's the difference between the two? Well, under both funding approaches, the contribution rate tends to rise as members acquire more service and get closer to retirement. However, the traditional unit credit contributions start smaller than the projected unit credit contributions because you count current salary for traditional unit credit, and you use projected salary for projected unit credit. Then TUC contributions rise more steeply, and they eventually end up considerably more than the projected unit credit contributions because they pay for the same thing. So you start out small, you have to pay for it later. So in the case, this is the case because the TUC contributions do not project the future salary increases or future service credit, while projected unit credit contributions are based on salary with projected future salary increases and assuming future service credits will be earned. So TUC contributions in any given year must reflect the normal contributions. The cost for the year must reflect a full increase in the salary and the additional year of service now reflected in the accrued benefit at the end of the year of service. The projected unit credit contribution will not need to reflect the additional year of service, as it was already reflected in the accrued liability at the beginning of the year. Now, it is possible that the projection was not perfect, and there may be increases after all, but the larger increases are built in the traditional unit credit. That's the point here. Please remember this is copyrighted material.